Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week of August 1st. We saw some sideways price action in the markets this week, so let's dive into the charts and see where we're heading from here. Starting out with the S&P 500, the SPY chart, we are sitting in a bull flag pattern, but also failed to get above a key Fibonacci extension level right around the 414.30 level on the SPY. And so we'd like to see a close above that for a break above that bull flag pattern as well as that Fibonacci extension. And if we see that, I think that'll be a pretty bullish for the markets, and we'll likely be headed higher from there. Still looking at that 200-day moving average as a real key level to watch for a potential top in this rally. If we do get up to that 200-day moving average, that would get us up to about between 430 and 434 on the SPY. When we jump over to the Nasdaq, we are looking really good on the Nasdaq as well. It's recovered quite nicely off of the bottoms, which in the Nasdaq, which was right around the middle of June, and it looks like we could see some more momentum to the upside from here. Also looking for that 200-day moving average as a potential top off of this bear market rally, which would put the triple Qs somewhere in the range of about 340 to 344 for the Nasdaq for a potential top. And when we take a look at the Dow Jones Industrial Averages, we are hanging out also in a bull flag pattern, very similar to the SPY. However, we are sitting above a key support level, which is about 50% retracement off of the last sell-off in the Dow Jones Industrial Averages. So looking pretty good there. Also looking for that 200-day moving average for a potential top, and on the DIA that would put us right around 339, 340. And then when we take a look at our Dow Jones Transportation Index, we talked about last week how we got back above this 1.618 extension off the pre-COVID crash highs, and we have held that this week. We did drop a little bit below it on the week, but managed to go ahead and close the week up above that Fibonacci extension level, so that's looking fairly bullish for the transports. As long as we're above that 14,373 level on the transportation average index, then things are looking fairly bullish for the transportation sector right now. Then we jump over to the Russell 3000. We did break above the center channel line that we've been discussing for quite a few weeks. We did that 2 weeks ago, and then this last week we held above it quite nicely, and now are coming up against the 100-week moving average, which has acted as resistance not too long ago, so we'll have to see if we can clear that. My guess is that if we do, we'll likely get back above to that 50-week moving average, and that might be a potential top, which would probably also coincide with a lot of those 200-day moving averages in the major indices. And so if we see all of those charts kind of hit those levels and then start to roll over, I think that'll be a warning sign that maybe the rally is done, but it looks like we still have some potential upside left to go in this bear market bounce. Then we jump over the Russell 1000. We're coming up against the 1.618 extension for our large caps, and we did not get above it this last week, so it'll be interesting to see if we can see large caps get back above 231 on the IWB, and if we can get above there, then that'll continue to look pretty bullish for large caps for this rally that we're seeing right now. And then we jump over to small caps. We have seen those perform really nicely. We're sitting at about almost 191 closed out on the week on the IWM, and I think the small caps potentially could see a rally back up to that 50-week moving average, which would put us around 204.50 on the IWM, and I think that would be a pretty logical place to look for a potential rollover as well. And then when we take a look at our growth versus value chart, value was the clear winner since last November, but that was a pretty major reversal towards the end of May, and since then we've started to see growth really outperform value. That really hasn't changed, I'd say, especially over the last 5-6 weeks. It's seen a very nice move to the upside on growth over value. Looks like that'll probably continue, and we'll be looking for that probably 1.66 level as a potential resistance area, which will probably likely coincide with the 50-week moving average as well. So we'll see if a trend change from there. But so far, growth is definitely looking like a much better place than value at the moment for trading stocks. And then we jump into our sector review. This is taking a look at all the sectors that we track over the last 2 weeks, so last 10 trading days. And we can see at the top here, solar and clean energy are the clear leaders. Solar's up almost 18% on the last 2 weeks, and clean energy's up about 15% over the last 2 weeks. I think a lot of that has to do with this new bill that's being potentially passed in Congress right now. It's expected to get through the Senate and to the president's desk and be signed. There's about $369 billion worth of clean energy investment in that bill. And so I think in anticipation of that getting signed, it's really started to make solar and clean energy stocks move to the upside. And I think if we see that bill signed, which we likely will, we could potentially just be seeing the beginning of what could potentially be a really nice kind of cyclical bull market in solar and clean energy with all this new investment dollars. It's about $369 billion over 10 years, so there's almost $40 billion a year that'll be invested into these sectors, and so I think that's going to be a really bullish catalyst for those sectors. Some of the other sectors we saw that were really strong, we saw biotech really start to bounce back. That was rallying really nicely, and then it kind of paused for a bit and sold off a little bit, but over the last couple of weeks we've seen it head back up to the upside, so I like the biotech sector a lot right now on the long side. And we've even seen a lot of the more speculative, non-profitable tech sector companies that the ARK Invest group likes to invest in. See some nice big rallies out of that, so we've seen a lot of the ARK FinTech, ARK Innovation moving to the upside. We've also seen some bullish momentum out of the cloud computing sector. Metals and mining's finally going to the upside after a really bad bear market in that sector. We're also seeing things like online retail and steel do really well. And then towards the bottom here, the only sector that's in the red over the last 2 weeks is the United States Natural Gas Fund, which is down almost 3%. But in the other sectors that have been clear underperformers are things like consumer staples, communication services, cannabis sector, emerging markets, and the healthcare sector. Those have all had some positive moves to the upside over the last couple of weeks, but very, very small, just about 1 or 2% moves to the upside. So really across the board, most everything has been green over the last couple of weeks. And I think we said that a couple of weeks ago as well. So really over the last 2, 3, 4 weeks, we've seen a lot of positive momentum in the markets. But I do not think that this sell-off is over broadly, and so this is very likely just another bear market bounce, just a much bigger one, and we need to be careful and make sure we've got some nice stop losses in our trades because at any point this thing could wrap up and we could start seeing things sell off again. So we want to be careful and not get too overly bullish longer term, because I think there's still some more pain in the markets going forward. And then we take a look at our U.S. oil chart. We saw that break down to the bottom of this upward channel line, and we're sitting at about $90 a barrel right now, $89 a barrel on oil prices. That's a pretty steep decline from just the end of June. We were sitting almost $125 a barrel, so we've seen a pretty big drop in the oil prices. So I've started to get a lot more bearish on energy trades. There's not a lot of energy trades that I'm in, and that's been really one of the best sectors on the year up until recently. I think this is looking like a potential trend change for the sector and for oil, which is, I guess, good news for the gas pump, but not so much if you're long on energy stocks, as we're definitely seeing oil heading lower from here. But we are at this channel line where it's acted as resistance many times, and so we'll have to see if that can hold as support, and we'll see if oil heads higher from here. But we are below the 50-week moving average now, which we have not seen a close below that 50-week moving average for quite some time, so that's definitely a trend change in the oil space. And then when we jump over to our CRB index, take a look at commodities. Similar story here. We saw commodities sell off pretty aggressively this week after a bit of a rally the previous week. My bet would be that the commodities space is likely heading down to test this channel here, which also coincides with the 50-week moving average. So we'll see if we get a drop down to those levels, and if it bounces off of that, holds as support, and maybe potentially heads higher from there, or if we might potentially see an actual close below that 50-week moving average, which we haven't seen in the commodities CRB index since November of 2020. So that would be a pretty major shift in the commodity space if we saw that. But we're not there yet, but it has been a sector that is starting to sell off quite a bit compared to what we've seen over the last year and a half or so. And then when we jump over to our consumer discretionary versus consumer staples, we saw a trend chain break on this a few weeks back. We got above this down channel trend line and tested at a support the previous week, and then now we're heading higher this week. So consumer discretionary which is your risk-on categories for the market, is outperforming consumer staples. So that's a bullish sign for risk-on assets, at least in the short term. And so things are looking good there if you're looking for some long opportunities off of this chart. And when we take a look at the All-World ex-US Index, so this is the global markets minus the United States, and we did see a bit of a down week, just a little bit on the global markets, but when we look at it on a relative basis, once again it was worse than the actual chart shows, and so relative to the S&P 500, the emerging markets are still trending down and have been for quite some time. And when we take a look at our high-yield corporate bond ETF, the HYG, we have bounced off of that 75 level that we kind of laid out as a real key warning area when the markets were selling off. We've regained that level and rallied off of it pretty nicely. So the next level we'll be looking for on the HYG is that 79.50 level. We'll see if we can get above that or not, or if that might act as resistance, and see if the HYG heads lower from there. But so far things are looking pretty good in the high-yield corporate bond market over the last 3 or 4 weeks now. And then when we look at it on relative terms compared to traditional treasury bonds, we're also back up into this kind of trading channel that we've been in for quite some time. We got back up there about 4 weeks ago, but this was a real strong move to the upside, getting all the way back up to the 200-week moving average. And so as long as we're kind of chopping around in this sideways price action, I think that's a pretty bullish sign for the markets. And likely when we see the markets sell off again, we'll probably see a failure below that 0.73 level on our HYG divided by IEF. And then taking a look at the metals markets, starting out with gold. Gold's had a nice little rally about the last 3 weeks. We've talked about in a short video how gold has is in a nice seasonality period. We also saw just not quite, but just about bounced off of the 200-week moving average, which you would hope in a bull market for gold that would be the support level and it wouldn't fall below that. So it did hold up above those levels, and we might actually see some tradable opportunities in the gold space going forward, especially if we continue to see interest rates go down. I think there's a decent chance that if interest rates are going down and we've got the seasonality push as well, that might be we might have some bullish opportunities in the gold sector for a bit. And then taking a look at our silver prices, we're sitting at about $18.33 an ounce. We had a huge rally 2 weeks ago on the silver prices. Really saw a big move off the bottom, which was sitting at about $16.75 an ounce. So now we're all the way back up to almost $18.33. We didn't get back above the 200-week moving average, so we'd like to probably see the price action get back above that level. And if we can, then that might be a signal that there could be some trading opportunities for the silver market. And then when we take a look at interest rates, we saw a pretty big rise across the board in interest rates on pretty much all the categories we're looking at here. We got our 2-year, our 10-year, and our 30. But this we're just starting this following week, and it looks like we're starting the week off a little bit down, so we'll have to see where we go from here on the rates. Rates were definitely starting to look like they were starting to lose steam and roll over, but then this last week was a pretty big move to the upside, so we'll have to see if this was a bit of a fake out with rates potentially putting a top in, or if we're going to be heading higher still on rates. And so right now we close the week out at about 3.3% on the 2-year. On our 10-year, we closed the week out at about 2.8%, and then on our 30-year, we closed the week out at about 3%. And then when we take a look at our yield curve, saw some pretty interesting developments there. We're extremely in the negative on our yield curve. That's our 10s minus the 2s, and we are actually just about at the lowest level that this chart's ever registered. So back in the financial or the dot-com bubble in the early 2000s, we saw this get at the most extreme reading, which was at about negative 0.52, negative 0.53%. And we're just about there. We bounced off of it and then started to head higher a little bit, looks like, for now. But we got pretty darn close to the lowest close we've ever seen in this thing. And I think a lot of people think it's probably going to go lower from here. So if we see a drop below that 0.53%, that'll officially be the most aggressively sold off negative territory yield curve we've ever seen, going back all the way into the late 1980s. And so I think that's still one of the major factors to keep an eye out and understand that there's a very good chance that this is just a bear market bounce and that we're likely going to see more sell-offs in the future. And I think this yield curve is kind of warning of that. And then, but when we look at things on a more local perspective, we've got our VIX that's now sitting at just above 20, which is about the lowest level it's been in, going all the way back to about April. And so, at least in the short term, I think the VIX is telling us that there's not a lot of fear in the markets and that this bear market bounce can potentially continue for a little bit longer. So the things I'll be looking for that potential rollover in the markets off of this rally, I'll be looking for those 200-day moving averages on the major indices. I'll be looking for the VIX to spike, and then I'll also be looking for potentially a dollar rising as well. And so when we take a look at our put-call ratio, we're sitting at normalized levels between 0.5 and 1, so there's no excessive put-buying protection going on in the markets right now, so people have kind of calmed down on buying defensive positioning for the time being. And then when we jump over to our dollar chart, the DXY, that's a chart I've been watching very closely. There's a very strong inverse correlation to the crypto markets with the dollar. Typically when the dollar is rising, crypto markets are selling off and vice versa. But that's also very common for stocks as well. And it's not a 1-to-1 ratio. It doesn't mean if the dollar goes up today that the stocks will go down. But over longer term trends, if we see the dollar going up, it's generally a headwind for stocks, and it's definitely a headwind for the crypto market. So I'm watching this dollar index very closely. I think if we see the DXY break above 107, 108, then I think that's a kind of a concern. And if we see the dollar get above that 108 level, then I think that's potentially going to be a warning for the markets as well as for the crypto. But if we do see the dollar stay below 108 and potentially head lower from here, then I think that'll potentially signal a further rally potentially in the crypto markets as well as in the stock market as well. And we'll go ahead and wrap things up with the Bitcoin. Taking a look at our Bitcoin chart here, we've saw a pretty steady but orderly correction recently in the crypto space. Got all the way back down to our 21-day EMA, which we like watching really closely. Kind of held that as support pretty nicely, and now we're starting to head higher. Would like to probably see Bitcoin get back above, say, 23.5 or 24,000. And if we do start to see it rally from here to the upside, still think there's 30,000 Bitcoin potential in the near term, as long as we can stay above these resistance lines and our EMA lines that we've got here. I think the bias is still to the upside on Bitcoin, and if Bitcoin's moving to the upside, I like trading the altcoins when Bitcoin's going the right direction. So keeping a close eye on that. I've got a lot of altcoins that I've got trades put on right now, and we've called out a few of them on some of our shorter videos, so we're keeping a close eye on the Bitcoin markets. Also like looking for some of the crypto miners, so if we do see Bitcoin really rally off these levels, I start seeing Bitcoin get above 24, 25 on its way to 30, I'll probably be looking for some call options in some of the crypto miners as well, to kind of capitalize some more trading opportunities off of that. But so far things are looking pretty decent. It was getting pretty close here as we almost fell below this resistance level, right around 22,300, but then we saw a nice little rally over the last few days. And as long as that can continue, things are looking decent for this crypto rally to potentially continue as well. But that's also why we're watching the DXY on that one closely, because that can give us some clues if we see any major moves either way on that chart as well. So thanks for tuning into this week. Make sure to like and share the video, and you can download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto. And we'll see you next week.